That's right, you're watching Traders Corner on Business Day TV, and with me at the desk to take a look at the charts is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks so much for your time today.
Thanks, hi Bronwyn.
So let's jump straight into it and take a look at the S&P 500. You have both the weekly and daily charts, so what are they telling you?
Yes, I like to look at the weekly chart each week, and I've been doing this since the start of the year. And the main reason being that the market broke down below the 50-week moving average at the end of last year, and it's been rallying back up to the underside of the 50-week moving average this year. That is the blue line that you see on the chart over there. Now, what's interesting to note is that this rally that we've seen off the December lows has been about 16% in terms of the size of the rally in 6 weeks. So it's been a very powerful rally, but admittedly off very, very oversold levels. Now, it's run up, it's pushed up into the underside of the 50-week moving average. That also happens to be the area where the 61.8% Fibonacci retracement of that entire sell-off comes into play. Now, what's also interesting to note is that last week's weekly candle formed what we refer to as a doji candle. It's basically where your open and close for the week is at the same level, and it implies that there's some sort of equilibrium now between buyers and sellers starting to merge. Whereas in the prior 6 weeks, we've seen buyers just flattening the sellers every single day and every single week. So it's interesting to note that we now have entered this period of a little bit of uncertainty just below the 50-week moving average. And the reason why I keep harping on about this 50-week moving average is because that has historically been a very good read of bull markets and bear markets. In the last two bear markets, really, we've had a situation where the market cracks below the 50-week moving average, and then it rallies back, gives a retest of the underside of that 50-week moving average before then falling away again. So it's going to be very, very interesting to see how it behaves around this sort of area in the next couple of weeks, and whether we consolidate here and then move higher, or whether we actually then make another leg to the downside. It wouldn't surprise me too much if we now start to consolidate and possibly even pull back a little bit from these lofty levels. If we look at the daily chart, here you can see we've got about 6 months worth of trading history on the S&P 500 over here. And what's particularly notable on this chart is that the market seems to have stalled at the underside of the 200-day moving average. That's that red line on the chart over there. And what's also notable is the fact that we've broken below this upward trend that started at the end of December last year. So that again suggests to me that there's a potential here for a little bit of consolidation in the near term. And it wouldn't be surprising to see that given the extent of the rally that we've seen over the last 6 weeks.
Okay, so then if we come back home, we're still kind of muddling along, if I can describe it like that. So let's take a look at the top 40 future, because you also had a trade last week there as well.
I did. So here's the daily chart of the top 40 future. This is the March top 40 future that we're talking about specifically here. And you're right, it's been muddling along. I mean, 48,000 has been an incredibly sticky level for this top 40 future over the last month or so. You can see how many times the market has oscillated around that 48,000 area. But it does sort of have the look of running out of a little bit of steam here. There's a bit of a rounding top shape to that pattern. And unless it can really push out aggressively to the upside fairly soon, that to me starts to look like it's a little bit fatigued in the near term. There is a gap on the chart down here at about 46,600, which we'll show next on the next hourly chart. That could potentially be a downside target if the market were to continue to roll over from here. But for the time being, you know, it's still very choppy, it's very messy, and still for the most part seems to be sort of gravitating around that 48,000 area. If we look at the hourly chart, which is where we did our trade last week, what I identified on last week's show was the fact that the market had been trading in that sideways or that upward sloping channel that I've indicated there. And it began to break to the downside last week on Tuesday when we were sitting here in the studio. So on the back of that, I decided to go short of the top 40 future. It was actually the ALMI future, which is the mini future. I did 2 of those, and I was really looking for a move down to go and target that gap at 46,600, which is from earlier in January. And I said I would put a stop loss above 48,000. Now, as you can see, my trade didn't work. It pushed aggressively higher through.
Well, it didn't work last week, but kind of frustrating that it could have worked a little bit further down the line.
For sure, exactly. But that's always I suppose hindsight is always an exact science. And in this case, I certainly was a victim of the whipsaw action that we've been seeing on this top 40 future over the last number of weeks. And I ended up being stopped out there just above 48,000. And that was where our stop loss was intact. We lost 934 Rand on that trade, so certainly not a train smash, a small amount of capital that we kissed goodbye there. And look, the market did move quite a lot higher afterwards, as you can see, but of course it's come down quite aggressively since, and for a moment we would have been looking good earlier this week. But as is the case here, we always stick with our stop losses, we always obey them, and we know what we stand to lose when we go into a trade. And we know always that one of the possible outcomes with every single trade is that you might actually lose money. And the critical thing when you go into a trade is to know how much that amount of money is that you possibly stand to lose and be accepting of that fact. So we execute the stop loss with discipline here. We lose a bit of money, but it's certainly not the end of the world.
Okay, but hoping that another trade for us that can pay off, that's this week's trade, and you're looking at clicks specifically.
Yes, I'm looking at clicks, and this is a little bit different. We're not looking at for particular technical levels or anything like that. Really, what's interesting here is that the company concluded an accelerated book build in some of their shares last week on Wednesday. Now, what an accelerated book build is where a large block of stock needs to be sold from one shareholder to new shareholders. It's usually a block of shares that is too large to push through the market in terms of the normal day-to-day trade. So what happens is you'll find that a bunch of investment banks, usually one or two investment banks, will work on a placement of the stock, usually overnight, and they will have contacts in the pension fund industry, the institutional industry, the hedge fund industry, etc. And they will find buyers to effectively take up the stock that's being sold. And in order to do that, because it's a large block of stock, you'll always find that the price at which the shares are placed is at a slight discount to the prevailing market price. Now, in this case, what we saw last week, Wednesday, was the Clicks Employee Share Ownership Trust had 7.8 million shares, which they needed to sell into the market. Now, if you realize that Clicks on an average day generally doesn't trade much more than 1 million shares on a normal day. In fact, that's even a decent day. Most days it's probably between 500,000 and 1 million shares would be the average daily trading volume for Clicks. So to try and push 7.8 million shares through the market is simply not going to happen.
Yeah.
It will depress the price and it'll just be far too cumbersome to do that. So hence they go about it as using an accelerated book build exercise. And as I say, this was announced last week, Wednesday. The book runner, I think, was Investec, and the shares were placed overnight. So the next morning we get an announcement that these shares were sold at 184 Rand each. Keep in mind they were trading at about 193 Rand before this announcement was made. So that's effectively a 5% discount to the prevailing market price at the time, or just before the announcement was made. Now, what ordinarily happens is you get a bit of a depressed share price that follows because you do have this short-term overhang of stock, but realistically nothing's changed at the company. And what typically happens with these types of situations is the share price will generally recover a week or two later. In this instance, what's particularly nice is we've got some precedent to look at. And if we go to look at the chart of Clicks in February last year, they did the same book build, the same number of shares for the same reason, for the same shareholder. It was also the Clicks Employee Share Ownership Trust that was looking to exit a block of shares. And at that stage, they did 7.8 million shares, also through an accelerated book build, also in February last year. And at that stage, they were placed at 166 Rand per share. And there you can see the reaction that we saw in the share price. There was a gap to the downside. It actually traded a little bit below the book build price, but not for very long. And then ultimately it did recover quite nicely after that. And that big volume spike that you see at the bottom of the chart there indicates that large block of shares moving through the market. Now, look, you can argue last year we had Ramaphoria and there's quite a lot of positivity around the retail sector and all of that sort of thing. So the recovery was quite quick. This year we sit in a situation where there's, I suppose, a little bit more circumspect approach to the market.
Yeah.
Ramaphoria has faded to some extent. We've now got load shedding and the like, which is denting the mood somewhat. But nevertheless, I still think Clicks has been an outperforming retail counter on our market recently. It remains one of the strongest retail shares. And I expect that we'll probably see a similar sort of reaction here where you get this short-term move to the downside in the share price. but it probably moves back up. And I think ultimately it moves up and it fills that gap at about 193.50, which was where the shares were trading prior to this book build being announced. So following that, what I've done is I've actually gone in and I've entered a trade in clicks at 184 Rand. I'm using a stop loss below 179, and I'm looking for a target up at 193.50, which is essentially meaning that it goes up and closes that gap from last week. So if we go through the mechanics of this trade, I'm buying it at 184 Rand. My stop loss is 179 Rand. Risk per share, therefore, is 5 Rand per share. I'm risking 1.5% of our capital here. So we've got 150,000 Rand at our disposal in our South African portfolio. So 1.5% of that is 2,250 Rand. And that's what I'd be willing to lose in the event that this trade is wrong and that it doesn't work. To calculate our position size, we take the capital at risk, that 2,250 Rand, and we divide it by the risk per share, which is 5 Rand per share. And it gives us a number of 450 shares. Now, because we're trading CFDs, it's a 1-for-1 conversion ratio. We've essentially gone long of 450 CFDs here. The target, like I said, is 193 Rand and 50 cents. And that means that my risk to reward ratio is 1 to 1.9. So, more or less 1 to 2, which is fine. That for me is sort of the least I would look at normally in terms of a risk to reward ratio to justify doing a trade.
Okay, so while we wait to see if clicks will play to our favor, let's take a look at the portfolios and start with the local portfolio to see how much of a hard knock we did take from last week's trade.
Yeah, so there's the 3 trades that we've done so far this year. We've got the ABSA trade, which was a short that we did a little while back. We made some money there. Then that ALMI futures trade last week, as I said, lost us 934 Rand, so it dented the portfolio very slightly. And we've got the clicks trade that we've entered this week. We are sitting with 151,685 Rand, so we're still up 1.1%. It's very, very early days in terms of the year, so we're still getting off the mark, as it were. But things are looking okay for now. And then in terms of our offshore portfolio, we've only got one trade. It's an option structure, a put option on General Motors, which runs out to April. So I've still got a fair amount of time here, and I'm still reasonably confident that that trade will work for us. Right now, it's making a mark-to-market loss, but I'm not particularly worried about it as things stand at the moment.
Okay, so we'll be keeping an eye on all those fronts. So let's now take a look, because you've got a couple of upcoming courses as well. If our viewers want to know more about it, how do they get in touch with you?
Yes, I'll be in Cape Town this weekend on the 16th of February, and then further on from that, the 9th of March, I'll be in Durban. So anybody that's interested in finding out about these courses, would like to book, please email me, garth@traderscorner.co.za, and I'll send you all the information.
Okay, and then also just a reminder to viewers, how can they sign up for your free weekly newsletter as well?
Yes, if you go to traderscorner.co.za and you look in the middle of the page there, you'll see a link for a free weekly email. Click on that, it'll ask you to enter your details, it'll take you 30 seconds. And then every Tuesday we'll send you an email detailing exactly what is coming up on this show each week.
Great, Garth, thanks so much for your time this week.
Thanks.
Garth McKenzie is editor and founder of Traders Corner.